Hello, my name is Nick Griffin. I'm the Head of International Strategy at K2 Asset Management, and this is the K2 International First Quarter 2015 webinar. This is essentially an ongoing update that we do every quarter to essentially take our clients through what we've seen in markets over the last quarter, what we think is going to happen in the future, and how the portfolio has performed over the last quarter and what were the moving parts. And from that point of view, it's a short presentation, should be roughly just 15 minutes, where we run through a fairly standard format, and we hope this proves insightful into helping you understand how your investments are going within the K2 International Select Fund. So the first slide I'm going to show you is a disclaimer. I'll let you read that in your own time. The next slide is just a quick summary of the topics we're going to go over, which is essentially the outlook for growth, the outlook for markets, an update on the portfolio, a quick update on some of our investments around the Internet of Things, and then a conclusion. We'll move through this reasonably quickly because you'll start to recognize, for those of you who've watched previously, that we're following a fairly standard format and essentially updating you on how things have changed from last quarter. So firstly, just on the outlook for growth, look, this slide just shows you US GDP consensus forecasts over the last 5 years, and what we've seen, and we showed you this last quarter, is that generally US GDP and in fact global GDP has disappointed every year compared to expectations, and so far in 2015, at the moment at least, it feels like expectations are holding up and if anything slightly improving. That's not just for the US but also in Europe and Japan, probably less so for the emerging markets. We'll show you another slide in a second. The main market of the world is obviously the US at the moment. It's been the growth engine, a powerhouse, as we've seen for the last few years. And what we're showing you here is US non-farm payrolls, a 6-month rolling average. And as you can see, we've had a sustained strong period of employment in the US, as we have elsewhere in places like the UK. And so from that point of view, if anything, that's getting stronger. And all of that is pointing towards the fact that the US Fed is probably going to hike rates for the first time in 8 years, sometime during 2015. And so there is, of course, much speculation about whether the Janet Yellen-run Fed is patient or not patient, or data dependent, or providing forward guidance. The reality is this is the forward guidance that the Fed has given us in the grey line, and the blue line is what the futures are expecting in terms of rate hikes. And so from that point of view, the market is expecting the Fed to be slower to raise rates than what the Fed is actually saying. And so from that point of view, a stronger economy in the US, at least from a market perspective in the short term, might be a little bit of a concern, because it would mean that rates would rise faster. A weaker economy, on the other hand, would also be a concern, because ultimately we do want to get out of this situation and have a situation where interest rates can move off the zero line. So it is essentially flagging a somewhat difficult period for markets ahead, and this is what we have to overcome, is the fact that rates are going to go up in more likelihood. Expectations are lower than what the Fed actually thinks, and those need to be balanced over the next 6 months. What we're showing you here is just global purchasing manager indices. Globally, we show you this every quarter. Purchasing manager index, over 50 is good, under 50 is bad, and it's essentially asking people their view of the economy. And as you can see, the US was very strong and has got weaker, particularly as the US dollar has strengthened. Europe was poor and has got slightly better. Japan is, I suppose, slightly positive, and emerging markets are still struggling somewhat. This disparity of growth around the world, particularly with the US looking to raise rates and others going the other way from a monetary policy perspective, and particularly Europe and Japan, has created a lot of volatility. We've shown you this before, particularly on currencies on the top left. It's been the big story for markets so far this year, as the euro has weakened significantly, like the yen did the year before. The Aussie dollar has weakened significantly. The US dollar has remained strong. This has put a lot of pressure on commodities in particular, as you can see on the right. We have sovereign bond yields that are still very, very low, particularly in Europe, and they're being driven down even lower by quantitative easing, and that's causing US bonds to stay low because they are at a spread to Europeans. And ultimately on the right there, we've had this rise in volatility pretty much since October last year that we have to negotiate. The other thing to flag is just inflation expectations. There has been a move here since last quarter. We showed you this slide at the end of December and early January, and effectively the market was pricing in short-term deflation. That has recovered significantly post the quantitative easing efforts in Europe, and also some slightly more dovish comments out of the US Fed. And so the market is moving through this this deflation shock, and long-term inflation expectations are well anchored, and so the deflationary threat, at least for now, has passed. That's essentially the outlook for growth as we see it, and to put quite simply, is nothing has changed in terms of the growth dynamic. If anything, it's probably got slightly better since we last spoke to you, and that is obviously pushing us towards these rate hikes in the US, which is going to create a different phase for markets. If we look at markets at the moment, the picture here has probably deteriorated somewhat since last quarter, particularly for the US. The S&P, as you can see here, we're showing you forward S&P EPS estimates versus the S&P 500 forward PE on a 12-month forward basis. And you can see from these bars at the top here that essentially estimates have rolled over, particularly in the last 2 quarters, mainly as a result of a weak oil price, but also as a result of the strong US dollar. And that has meant down here that the US market has got more expensive since the start of the year versus earnings expectations. So even though the market's gone nowhere roughly in the US year to date, earnings have come down, and hence the market is now more expensive. That being said, the positive equity carry trade still exists and is likely to continue throughout 2015. And what we're pointing to here is that the earnings yield of the US market is still significantly above the US 10-year bond yield. And as I flagged earlier, the US 10-year bond yield is being held down by ultra-low rates in Europe and Japan and elsewhere. And what this means on the right here is that corporates can still borrow money particularly cheaply. Apple borrowing $5.5 billion of 8-year money at 2.4%. General Electric down the bottom doing 2.2% for 5-year money and 3.4% for 9-year money. And so all of that means very cheap financing, and that is in turn driving deals like you saw the Kraft Heinz deal that we've already seen so far this year, and also the United Health deal. And so that is essentially driving M&A, and also allowing corporates obviously to continue to buy back their stocks in large amounts. And so that is an underpinning for the market, because rates, while they are going to go up, are probably not going to go up significantly, and long-term rates still seem to be quite well anchored at a low level. In terms of global market valuations, we showed you this chart at the end of the second quarter or in January, and essentially most markets have got more expensive since we last showed it to you. In the S&P's case, that's because earnings have fallen. In Europe's case, it's because the market's gone up an awful lot. China, even the Shanghai Composite Index was trading at roughly 10 times when we spoke in January. It's now at 15 times 2015 earnings based on essentially strong H-share performances. So in terms of valuation, the markets are less attractive than they were a quarter ago, and I think that's about the best we can say there. Still not massively expensive by historical perspectives, but definitely no longer cheap. Just in terms of a portfolio update, as you know, we have 3 tools for creating value in the K2 Select International one. The first one is Alpha, which is essentially the stocks we pick, and everyone can do that. And most funds you look at will do that. Second one is Variable Beta, i.e. do we need to be fully invested or not fully invested in markets? And the third one is Currency, do we need to be hedged or unhedged markets going forward? And so from that point of view, I'm just going to take you through where we are positioned on all 3 of these. Firstly, we'll deal with Variable Beta. This is the net exposure of the K2 Select International Fund since inception. And as you can see over here, we have been running quite high exposure through the end of last year, but we have dropped that exposure just recently into the end of this month. And the fund is now 80% invested, having been over 90% invested for most of the first quarter. So we have essentially raised cash levels slightly, and we'll probably continue to do that as we move through April and May, which are generally seasonal difficult parts of the market. On the currency, we fully unhedged. We gradually unhedged the currency from 2011 to 2013, and then we fully unhedged it in the second half of 2013. And that's obviously been beneficial for us because the Aussie dollar has continued to fall versus the US dollar, and that has allowed us to gain foreign currency gains as well as stock gains on our offshore investments. And so from that point of view, the key thing we're following there is the Aussie versus US 10-year bond spread versus the Aussie dollar. And all this chart is showing you in the light blue here is the spread between the US 10-year bond and the Australian 10-year bond, and obviously that is shrinking considerably, and the currency is following that, and the bonds are merely reflecting the growth outlook in each country and the interest rate outlook in each country, and as it shrinks, then the currencies weaken. And so from that point of view, while the Aussie dollar has weakened significantly, there is room for it to fall further, and from that point of view, we're at least at this point remaining unhedged all our foreign investments. And hence we will benefit from a falling Aussie dollar, but vice versa, we will lose money if the currency rises. And then in terms of performance of the fund over the quarter, and we'll talk about the stocks in a second, this is essentially the spread of the markets over the quarter, and obviously a huge divergence this quarter, and obviously some new leaders, complete reversal of essentially last quarter, but you can see there the one in the middle there, that's Europe. European markets were up 16% for the quarter in local currency terms. In Australian dollar and US dollar terms, it was significantly less than that, because the euro was falling significantly through this period. Important to flag, we made all of our investments in Europe on a hedge basis, so we essentially shorted the euro against US dollars for our European investments, and hence we picked up the stock gains but didn't suffer from the currency falls. We are doing exactly the same thing in Japan, and you'll notice many people are doing this because it was essentially a fairly one-way trade for the quarter as the US dollar rose, as the Europeans moved to significantly weaken their currency, and that was obviously very good for European exporting stocks or exporting companies. Big divergence, and then over here on the left you have the US, which essentially did nothing for the quarter for the first time in a while, and then a mix in between the Nasdaq, the Russell, etc. In terms of us, this is us on the right. Fund was up roughly just over 10% for the quarter, and outperformed the index. We were, I suppose, lucky, or we did well to have a good exposure to Europe, a good exposure to Japan. In the US, most of our investments were in the Nasdaq. And we also, as we forewarned at the start of the year, have some reasonably large exposure in China also. And so all of those things combined to create the outperformance that we had over the quarter. Just a quick recap of markets, and I'll let you read this in your own time. But from our point of view, or at least from my point of view, the things to flag here in terms of IPOs, the one to notice here is Aena in the middle, which is a Spanish airport. First big Spanish privatization we've seen for quite some time. Came at a good price and has since already risen 50% from its IPO price at the start of February. And so from that point of view, despite the fact it was an $8 billion or €8 billion deal, so that's a good sign for Europe, and obviously a good sign for markets in Europe, and obviously the privatization is good for the Spanish economy. Amongst M&A, obviously the Kraft and Heinz merger, backed by Buffett, very much driven by cheap money and synergies. And then we'd also flag a bit further down, Apple's launching the iWatch, which goes on sale this weekend, I think, or next weekend. And then finally down the bottom in terms of geopolitics, we just flagged that the Grexit or the Greek exit is still out there, and if anything is probably a 50-50 possibility here. And from that point of view, it will be very well managed, we suspect. And as you can see, markets have essentially moved on. And if anything, the European quantitative easing program has essentially eradicated this as an issue in the short term. Russia still looks difficult. Middle East obviously still has issues. A lot of those problems haven't got much better. Just in terms of fund performance by stock and by region, and again, we've been turned on our head here. Europe was the best performing region for the quarter, and China was the worst for us. From that point of view, that's a complete reversal of what we saw last quarter. In the US, we did very well. We were quite happy with our performance in the US, considering the market was flat. And as we flagged earlier, that came mainly from our investments in semiconductor stocks in the Nasdaq. And obviously, we had some good returns from our small cap holdings in Australia and Japan and elsewhere. These are all local currency returns, of course, and so the currencies were essentially hedged out by region. Just in terms of the stocks on the left, Fosun, which is essentially a China A-share play, was very successful for us. We spoke about the Internet of Things plays, or the Nasdaq plays, and that's Skyworks, NXP Semiconductors, Avago Technologies, and you could also put Apple in that camp. That's been a big discussion point for us last quarter and the quarter before, and it was heartening to see that one come in. Some of us, I said, small cap Aussie stocks did well there, and from the detractors, unfortunately, Intel was part of the above basket but didn't work because it's too exposed to PCs, and then obviously some of our Chinese SOEs took a breather in the first quarter. But that's essentially how the quarter played out by region and by stock in local currency terms. In terms of our top 10 holdings at the end of the quarter, you'll recognize the two at the top. They've been there for a while, Disney and Apple. Retail Food is one of our small cap Australian holdings. Fosun International, as I discussed earlier, is new to the fund and was a good performer for us last quarter. We expect that to continue. And Tessa is an Italian bank. Rightmove has been with us for a long time. It's essentially realestate.com in the UK. Roche has also been with us for a while. Swiss Pharma, Ontex, Belgium Nappies, Incontinent Nappies, would you believe? And ASICS is obviously athletic equipment in Japan. And ASML is again semiconductors or semiconductors lithography equipment listed in Holland. The last thing we're just going to take you through quickly was just a quick update on our Internet of Things bets. As we flagged this for a couple of quarters now, and they have done very well. We do expect them to keep doing well, although they will probably pull back at some point, at least to take a breather. But just to clarify one last time, and where we're thinking about this, what we showed you previously is that we have this thing that is essentially the Internet of Things or a connected world. And there's really only three things you need to think about here that make this happen. One, which is Moore's Law, which means the cost of a connected device has fallen considerably and continues to fall year after year. Secondly is cloud computing. So the data from that connected device can now live in the cloud, and through wireless internet being ubiquitous, it can essentially all be sucked up into the cloud quite quickly. And then the third is essentially device proliferation or big data. The more devices you have, the more essentially go into the cloud. And so what that does is it essentially feeds on itself to create this universe of data and information that essentially is available to everybody real time, all the time, everywhere they go. And we think that creates device proliferation. And so what we've done is bought the weapons manufacturers essentially across the handset universe, across the car universe, and across the semiconductor equipment makers universe, and that has proved quite successful. I think where we're moving to now is on this final slide, which is the connected car. We do think that the car is where a lot of this money is going to go in the short term. It's worth flagging that only 25% of cars in the world at the moment are connected to the internet. We think that goes to 100% by 2025 of all new cars. And the reason why is because if you connect your car to the internet effectively, all these things like its advanced driver assist, infotainment, traffic updates, real-time car diagnostics between the OEM and yourself, and also miles traveled data can go to insurers to adjust your insurance premium, and then eventually all the driver assist or even self-driving cars are going to require that connectivity so that they know where they are on the road and they know where they are amongst other cars, etc. So you firstly have this one situation where the cars are connecting to the internet, and that's creating a lot of demand for semiconductor chips, particularly connectivity semiconductor chips, and that's what Skyworks and people like Avago are doing. The next area is essentially in car sensors or car microcontrollers, and it's worth also flagging that if you go from an internal combustion engine to a hybrid or an electric, you essentially double the microcontrollers and power semiconductors that are required within your car. And so from that point of view, we have seen companies like NXPI, which is also in the fund, and we've seen them merge with companies like Freescale, that's also on this slide, to create dominant suppliers to the car industry. And so basically your chip content in a car is going to double and probably triple and quadruple over the next 5 to 6 years. And so we would see that as a structural change. And it's all happening because the technology is now cheap enough and the connectivity is cheap enough to enable all these things to happen really quickly. And that's what we're talking about here. So you're getting this huge acceleration in technology that goes into a car that makes it a safer, more comfortable, more completely different mode of transportation than in the next 10 years than it was in the last 10 years. And so from that point of view, a lot of these suppliers are seen as cyclical because they're seen as auto suppliers. but their content in the car is essentially quadrupling over the next 10 years. And so from that point of view, they are in this structural period. And all of them we're quite excited about because all of them trade below market multiples. And the reason why they trade below market multiples is because people think this is cyclical. But ultimately it's not. Safety is pushing towards this connectivity. Driver user helpfulness is pushing towards this connectivity, and then finally, cost, insurance, etc., diagnostic is pushing towards this change. And so we expect this structural change to occur. It's been happening in handsets and around your home, and it's in the car. We just think the dollar content in the car is really going to accelerate now. And so from that point of view, we are following this trade, I suppose, through handsets, through devices, and eventually into cars. And the companies at the bottom here are some of the ones that we are currently invested in and others that we are looking at. Look, so finally, just to conclude, we still remain positive on global equities, although we have obviously pulled back tactically or somewhat seasonally our exposure as we move into this difficult period. The first rate hike will be somewhat volatile for markets. Currencies are also creating volatility, and so from that point of view, it is going to still be a volatile period. And we've had a lot of volatility already in the last 6 months, which we've managed to negotiate. We're just flagging that eventually this is going to get harder and harder to negotiate. The good news is the March quarter was a positive one for the fund. It was up 10.7% versus the index up 9.6%. The second piece of good news is we bank some of that essentially by reducing our exposure. Thirdly, on FX, we remain unhedged the Aussie dollar, and we expect it at least to remain weak over the medium term and potentially weaken a little bit further. But from that point of view, we are unhedged. At some point, we will hedge that currency going forward. Thirdly, on the stocks, we remain very confident on the strong earnings growth characteristics of our investments. And while the styles can re-rate and derate, and often through this period we do see a bit of a derating, over the long run we're still very happy with the stocks we're invested in. And then finally, look, I showed this to you last quarter, but we are still very focused on companies that have stable and strong dividends in a low rate world. We're focused on companies that have predominant US dollar earning streams. Where, as we said, we still have our bets on the Internet of Things, we have a bet on SOEs, and we also have essentially a bigger bet than we had probably last quarter in Europe. That is essentially it. Thank you for listening. If you got this far, please get in touch with any of our BDMs or with myself directly if you have any questions on how the fund is invested or how we're looking at the world going forward. And we hope that was helpful to you. Thanks very much for your time.